Today we're going to learn about infinite banking. This is just the basics. So this is more about what it is and maybe who it's good for, kind of how it works. And then as the weeks progress, we're going to learn how to actually design one of these, how to read the illustrations, how to present it to a client, and all the nitty-gritty details will come. So this is very open forum. So y'all, like I said, don't raise your hand. I'm not going to be watching that little screen down there anyway. I'm looking at this screen. So just unmute yourself and speak up if you have a question, okay? So infinite banking, believe it or not, is not a new concept. I don't know if y'all have ever heard of a thing called life insurance, but when life insurance was invented about 200 years ago, the purpose was for you to use it while you're alive. That's why it's called life insurance, if you notice all the emphasis on the correct syllable, right? So if you look at what we consider life insurance today, that's actually death insurance. So a lot of you sell term and final expense, and to me, that's death insurance. That's what, you know, Shelby gets when Sandy kicks the bucket, right? Sorry, Sandy, you're probably the oldest one in here, man. Death insurance versus life insurance. The way life insurance was invented to be used a couple hundred years ago was supposed to be kind of like how an IRA works. It was a vehicle where you would put money and it would earn interest tax-free. In fact, there's 3 tax laws that protected life insurance back then that still protect it today. You have tax code 7702, which allows you to grow money inside of this account 100% tax-free. Then you have 72E, which allows you to take loans out of that account so you can start a business, buy a car, send your kid to college, whatever. So you know, the loans were tax-free. And then, of course, everybody should know 101A, and that is where when you die, you transfer your wealth from one person to another tax and probate-free. And to this very day, the only way to transfer wealth tax and probate free in our country is using life insurance. So everything else can go through probate. Unless you have a trust, which, you know, we can talk about on another call. So we call it infinite banking concept, BYOB. It's becoming your own banker, not what Matt was thinking. But it really kind of gained a little bit of momentum, you know, obviously when the Rockefellers became the first registered billionaires in the country using a life insurance and a trust setup. But Nelson Nash wrote a book explaining kind of how it worked and what they did. And if you don't have this, it's a great book. You can get it on Amazon or an audio book or something, listen to it while you drive. Infinite banking, what is it? First of all, you hear me make the mistake of saying, you know, we're talking about an IUL one week or an IBC the next week, an infinite bank. Technically, infinite banking is a concept. It's not a product, it's a process. And technically, it's where we put money in life insurance that earns interest, and we can use that money tax-free, no penalties, no fees, stuff like that. You could technically do that in an IUL, right? You just need to wait about 5 years to touch the money. So the proper way to do it is to use a dividend-paying whole life, and that's actually what the Rockefellers used. And I've had people argue with me on that, and I'm like, can you just go to Google and type in, when was the IUL invented? Because that was in 1997 and he's dead already. Like, he'd been gone a long time. So that's not what he used. Anyway, he called it his waterfall method, if you've heard that, or his family bank. So that's what we're going to learn, is how that exactly works. What we do is we take a dividend paying whole life insurance policy, and for us to be able to sell it, we have 2 qualifications. They have to have been in business for more than 100 years. And they have to have never missed a single dividend payment. So that means that during World War II, Great Depression, market crash, 9/11, and even coronavirus, like all these major catastrophe type events in history, the companies that we're allowed to offer to our clients have never missed a single dividend payment. Why is that a qualification? So I can't call dividends guarantees. Right. So you're going to get a 4% guarantee inside of the policy. You're going to get that on just about every whole life. So, you know, the 4% is contractually guaranteed. I can't guarantee a dividend. What I can do is I can say, you know what, I've got a company over here that's been in business for 154 years, and not once have they ever missed a single dividend payment. In your lifetime, if the current average is 9.9, well, I'm calling it 10%, is 9.9%, right? Dividend plus the guarantee. If that's a 154-year average, there is no possible way that that is going to change in your lifetime unless Jesus comes back. And I got this for you. If you didn't know this, when he comes back, you don't need life insurance anymore. See?
Hey, Shannon.
Yeah.
Is this slide deck on your site that we can download?
Yes, ma'am.
Okay, awesome.
It sure is. All these are. Yep. And don't be, just download them all and just open them, but you'll see them.
Yeah, I just was taking screenshots and I thought, well,
Oh,
that's a waste of time if I can always get it. So
gotcha. Yes, ma'am. So here's the big question that a lot of people ask, and mainly clients, but especially, agents. A lot of agents don't know this, because when we start off, like I started Aflac, I don't know what a dividend was. That's not part of the game. If I sold just basic life insurance, term, mortgage protection, all that stuff, they don't really have dividends, or I didn't know what a dividend, I never heard of a dividend, right? So what is a dividend? And life insurance, it's where the insurance companies made too much money, and they have to pay that money back, and it's going to go to somebody. So it's going to go to one of two people. It's going to go to a stockholder, or it's going to go to a policyholder. So most insurance companies are stock-owned companies, right? So, I mean, I'm just going to use Transamerica because they're a huge company, been in business for 100 years, right? So everybody knows their name. Let's just say that Heather and Sherry, you all have life insurance policies with Transamerica, and in the contract, you earn 4% a year. All right. So Leanne and I, we don't even pay for a policy. We just buy stock in the company. Now, at the end of the year, Transamerica does well based off company performance, right? So company performance is what drives the dividend, not the stock. But at the end of the year, their company performance increased their stock, and now me and Leanne get that 6% dividend. Right, so y'all got the 4 because you're a policy holder. We are stockholders, and we got 6. Well, a mutual company is not publicly traded. There is no stock. So now Leanne's 6% and my 6% go to Heather and Sherry. So you all earn 10%. Does that make sense? Because you can't legally promise people 10%, and you need to know how to break that down, because people are going to ask, like, well, you keep saying this 10%. And I always say about, or roughly, I'm never going to make it sound like a guarantee. And I explain it very well and make sure people understand that 4% is guaranteed, the dividend is not. But the dividend's 154-year average. So again, Jesus, or maybe the Terminator or the Matrix. Those are the 2 movies I've seen that maybe we are hiding inside the core of the earth for machines and we no longer need life insurance. That's the only way that could go down. People that have used this in history, these are just some of my favorite ones. All right. Walt Disney, I was not there. I'm paraphrasing. So if you Google, fact check me, whatever, I'm sure I'm getting this story a little bit confused with something else. But Walt Disney in 1930s, I believe, had the vision of starting Disneyland, 30s or 60s. Anyway, he goes into either 8 or 9 banks, and he says, I need a loan for a business. Now keep in mind, Walt already had Mickey Mouse. He was already very famous for Mickey Mouse and animations and, all this stuff. So when he goes in the bank, like, they know who he is. And I don't know what he said to get kicked out of the bank, of all of them, but it had to have been something like, hey, I need a loan for a business, and the loan officer had to have said something like, great, well, what's the idea? And I guess he said he wanted to build a magical dream castle for toddlers. Maybe that's what got him kicked out. Change the pitch, Walt. But anyway, 8 or 9 banks kicks him out. He goes back home to Big Brother Roy Disney. So if you don't know, Walt was the visionary, and he did not care if it bankrupted the company, did not care what it cost. He was going to make it happen, and it was going to be perfect. And if it wasn't perfect, you were going to start over and you were going to do it again. So now Big Brother Roy had to find a way to pay for it. He was the money manager. So when Walt goes to Roy, and he's all depressed, I can't start Disneyland. The hopes and dreams are crushed. I can't get the loan. Roy said, you do understand that that's what life insurance is for. If we can take a loan out of our life insurance, we can start Disneyland. He pulled a loan out of life insurance and started something called McDonald's. He saved his company, pretty obvious, named after him. He saved his company in the Great Depression. He couldn't make payroll. He was going to have to lay off tons and tons of people. They lost their houses and everything they had. And he took a loan out of his life insurance policy and kept the party going. The presidents, right? Like, all the presidents in history have used this. Do you think it's because they're the brightest bulbs? No, but it's because they have good advisors that tell them what to do. They have all these people around them that advise them on war strategies and finance and this and that. So that's why about every president we've ever had has used infinite banking. Obviously Rockefeller, right, made it very famous for what it is today, first registered billionaire in our country. And I don't think people understood just how stupid rich that family was. But when the United States was in money trouble, he wrote them a check. Here you go. Oh, y'all got like trillions of dollars of debt. Here, let me write you a check. Here you go. All right, just pay me back when you can. Can you imagine having enough money to loan the United States money during financial crisis? Like that's just wild. And still to this day, 14 generations later, they're still stupid wealthy. Now look up the Vanderbilts. That was their neighbors. They actually had more money than the Rockefellers at one point, but they lost it all. They went broke, and they within 4 generations, just because they used traditional banking methods. So when tough times hit and the bank comes and says, hey, we need that payment or we're taking your stuff, they took their stuff. So the next thing I always like to ask, especially clients, is what do banks do with your money? And some of y'all have seen this before, so y'all gonna know the answer. But I ask them, hey, what does the bank do with your money? And people go, every time that they go, well, they loan it out to other people. I'm like, yes, that's good. Very, very good. They do. And that's called fractional reserve banking. That's where banks can loan out $1 to about 10 different people at the same time and collect interest from all of them at once. But that's the second thing they do. And then they look at me and they're like, I'm like, but first, what they do is they invest it. Where do you think they invest it? And they're like, stock market? Like, yeah, close, but no, not at all. It's actually something called life insurance. Have you ever heard of it? And they're like, well, yeah, of course. What do you mean banks invest money in life insurance? That can't be right. Yes, here's a list from the FDIC. It's updated every quarter, and it shows you how much life insurance assets every bank in the country owns. This list is roughly 3,000 banks long and totals about $209 billion, B as in boy, $billion of life insurance. So just, I don't know if y'all have seen this yet or not, but Sherry, let's just play for 1 second. Do you have a bank or a credit union?
I have a credit union and a bank.
You have a bank? What's the name of the bank? We're not going to look at hack your account or anything. Texas First Bank, small bank, 673rd on the list, but they own $18.8 million of life insurance. So if that doesn't prove right there that they are taking your paycheck and they're depositing it into life insurance so they can earn roughly, it's typically 6 to 10% the way they do it with BOLI, bank-owned life insurance. So they earn interest off of your money. Well, now they have to give you something. I mean, you loaned them money so they could invest it, right? It's only fair. So now they give you like 0.01, 0.03. Now, if you have a credit union, you're getting about 0.03 to 0.06. So you're really rolling. But I show it to people and I'm like, all right, so here's what the banks do with your money. So you can tell when they get the whole concept of infinite banking. It's like a light bulb goes off in their head. In the beginning, they'll ask you things like, how much do I have to pay a month? How much do I have to put in to get it started? Right? But once you break it down simply and you go, right now, 100% of your paycheck is going to the bank. They're putting it in life insurance. They're earning 10%. They're giving you back 0.01. All I'm saying is keep putting money in there, right? I mean, you got to have accessible money, easy money, bill money, card swipe, checkbook, whatever, right? That's bill money. But then whatever you have left, I'm not even saying take all of it. I'm saying take some of it and put it in your own bank where you became the bank. Now you're the one earning the 10% interest. You're the one that controls your money. And as Rockefeller said, he who controls the bank controls the money. That's why he opened his own family bank. So let's keep going here. Questions on this? We good? Very good. Let's see. All right. So here's just a little diagram. This is, you guys making piles of cash and depositing at the bank. And then, of course, they loan it out to all these people for different things. And that's the fractional reserve banking. So like I said, all I'm saying is maybe replace the bank with the policy that pays you, which turns you into a bank. And now all that money stays in the family, right? You are the one that earns the interest. When you pay off that house, that car, that debt, that whatever, you're paying yourself a little bit of interest. Yeah, the insurance company's charging you interest, of course. And people ask, well, how do I pay that loan back? Or when do I have to pay that loan back? Or how much do I have to pay? You don't have an amortization chart. You are the banker. If you miss, 20 years of payments, they don't care. They're not going to send you a letter. You're not going to get any text or phone calls. You pay it back if, when, and how you want. When you make a payment, some of that money goes into your account for interest and some of it goes into their account for interest. So you're both making a little bit. When you have that loan paid off, do you know you can use that same loan again? So let's say you buy a $35,000 Jeep and then you pay that off and it's paid off now. All right, you've made a little bit of interest and now you can take that exact same $35,000 and do a little remodeling on your house. So you're literally just recycling the same dollar. The cool thing is when you're buying this car with that $35,000, your $35,000 is still sitting here earning you 10% interest. So your money is literally in two different places. That's why I call this OPM. You know, I buy my cars, my houses, my assets, everything. I buy it all with OPM. Somebody tell me what that means.
OPM.
Overpayment money?
Close. You got the money part right. Other people's money.
Other people's money, yeah.
I will buy it all.
All right, I got. All right,
I want some of other people's money.
Do you have questions, Andy?
Yes. So I'm chewing this all up here. Okay, so the difference between the IUL and your own bank is basically IUL got to wait, 5 years to actually get to touch the money.
Right.
Now
right.
you're bank and the bank. So let's say I have $50,000. I'm going to open this account and I'm going to make this my bank. I can start withdrawing from there, and that money's going to be there, generating wealth still or interest.
Interest, right?
Is that correct?
That's correct. Yeah, just same as your IUL. Same thing. They're both earning interest. You can touch the money in both of them. The big difference is this one, you can touch the money day one. If you put 100 grand in today, you could borrow 100 grand tomorrow. Right. With an IUL, you couldn't. If you put 100 grand in, one, that's a bad idea on an IUL is to put in a large lump sum because it jacks the death benefit up. And if you don't put 100 grand in every year, you can't keep up with the rising cost of insurance and fees in an IUL. So an IUL is more what I would consider a retirement account, long-term growth plan, like a 401k. You sock money away over time, and then you use it for retirement. Now, if you want to touch it along the way, yes, you can, but you should wait 5 years. So my big question to people is, when do you want to access this money? If it's before 5 years or after 5 years, that kind of helps me know which way to go. And if they're really not sure, I usually show them both and I'll explain both. And that way they can make their own decision. Because I don't know what they might be thinking. I'd be okay waiting 5 years.
Like you explained to me from you, it's like, hey, I can wait the 5 years. But if I take my 401 and say, okay, I'm going to put 70 grand in there tomorrow, I can use it right away.
Yes, so you would want to put that into
That's
this.
crazy.
Now, I say that, and it's been recorded, so let me clarify something really quick. You guys are insurance advisors. You're not tax advisors. You cannot legally tell Sandy to cash out his 401k and put that money in here. First of all, if he has 70 grand, it's probably not a bad idea. I actually did that. It was during COVID. I knew the market was going to crash. I thought I'm going to save myself a lot of money if I go ahead and cash this out now and just take my 10% penalty, my 20% federal tax hit. I'll lose about 30% right away. And I did. But with the market crash, I would have lost a whole lot more. Now, if somebody has $1 million, and I'm suggesting that they go ahead and cash out and they're going to lose $300,000, well, that's a little bit tougher pill to swallow. But you got 70 and you lose, I can't do math in my head, but let's just say you lose 25.
25,
right?
yeah.
Yeah. So now you take the 50 that's left, you put it in here, and yes, you have access to 50 the very next day. And that's
But
how
you have to still put more into it, or is it just leave it and go from there, or you can add anytime you want?
You can add anytime you want. You can make deposits. So instead of premium payments, I call these deposits.
Okay.
When you pay a premium payment, all that money goes to the insurance company in the form of a bill. They get to keep it all. This is different. When you make a deposit, you're putting money in a bank. Well, in this case, that bank is a life insurance policy. So you are paying for the coverage. So when you make your deposit, they take a fraction of it, a very small portion actually, and that goes to them that they get to keep. The rest of it goes into your account and it grows money.
Oh, we're going to talk.
Question, is there an age restriction on this? Are you
18 years old? You can't open a PUA, which is we'll get to what that is, but that's the bank account portion of this. You can't open a PUA inside of this life insurance policy unless you're 18.
Okay.
Other than that, age as far as how old, Not really. It doesn't really matter. Their max is probably 80 or 85. I have to look it up. I haven't written one on anybody over probably 78 myself. Now, the younger, the better, kind of like an IUL, right? Not exactly. It's not quite as rough as an IUL. IUL obviously is much better for a 20-year-old than it is for a 50-year-old. Does it work for the 50-year-old? Yes, we looked at that last week. They're still very, very strong. If somebody's over 55, I tend to want to lean towards this just because there's no fees, not at all, right? And you have rising cost of insurance on the IUL. There's no rising cost of insurance on this. It's level. So whatever age you are when you sign up, it stays there. Versus, you know, if you have a 60-year-old, the price starts here, right? And then you got like Jersey over here. What did you say you are? 20, I keep thinking you're 22, man.
I'm 28.
So 28. If you're 28, the cost of insurance is here, right? If you're 68, the cost of insurance starts here. Well, on an IUL, they both go up. So this one goes through the roof. You know, Jersey can afford for it to go up because of his age. The 60-year-old can't. So that's why I try to word that as the IUL to me is more like a 401k, more used for retirement. So if you call me and you're 60 years old and you're saying, I want to use an IUL for retirement, I'm like, you know that that's in 5 years, right? So you got to put in a lot of money to play catch up because, you know, you probably should have been doing this when you was like 20, 30. This one's different though. This one's just a bank account. So it doesn't really matter their age as much. But also, I have never had anyone I had to turn away. I just had one yesterday, and he was like, I don't want to waste your time. I've already met with 2 or 3 people, and they told me I don't qualify because of this, this, and this. I said, okay, no problem. I said, well, here's my calendar. I'll give you a call, you know. So I called him, and I said, so yeah, a lot of agents just don't think outside the box. I said, you didn't call those agents saying you wanted a big life insurance policy, did you? He goes, no. I said, why'd you call them? He said, well, they had a video like yours about infinite banking, and they told me I don't qualify. I said, you don't qualify. That's fine. Yes, you married? You got kids? A business partner? A cousin? Anybody with an insurable interest? And he was like, yeah, I'm married. I got kids. I said, how old are your kids? He goes, got $2, 42 and 44. I said, okay. If you went to the bank right now and you want to open a checking account, and they said, sorry, you don't qualify because you know you got COPD, but you can get one of your daughters to be a cosigner. Does that make sense? You've heard of that, right? A cosigner and a checking account. That's what we're doing with life insurance. There's 4 parties involved here. The person that's covered, that's your daughter. The person that owns it, that's you. That's the person that makes decisions on what happens with this money. So daughter can't just go buy a couple jet skis, a Corvette, or whatever, right? Whatever she wants. 40 years old. Hopefully she's more mature than that. But even me at 40, I probably would have done that. So here's a good case study for this. There's 4 ways that you could buy a vehicle. All right, you could finance it, which is the most popular, and there's nothing wrong with that. You know, you're just paying the bank to borrow their money. You're not paying them a ton in most cases, but you know, you're not making money. They're making money. Then, you know, where I live in Eastern Kentucky, so I'm allowed to say this, most of my friends are good old country boy rednecks. They do anything for you. They're the nicest, sweetest people. And they're like, well, man, that's why I ain't got a payment. I paid cash for my truck. And I'm like, all right, Bubba, you didn't like wake up and have 40 grand to buy the truck, did you? No. Was it gifted to you by like a relative that died? No. How'd you get the 40 grand? Well, I had to save. Okay, that was your payment. How long did it take you to save? About 3 years. Okay, that was your payment. You put money into an account, right? You made payments into that account. That was your savings. Have infinite banking, and then you actually have, let's just say you could pull money out of a 401k and buy. Look at how these look. On a little chart here, let's say that you finance it, right? You don't have the money, so you go in the hole. You owe them money. You're making payments. Well, guess what? In 5 years, your car has 120,000 miles, dents, dings, scratches, transmission's kind of a little wonky. You got misfire in cylinder 5. You know, so you need a new car. So you're just refinancing a new car, basically, you know, getting a new loan every 5 years. You're always in the hole. You're digging out of the hole, then you're in the hole again. You're not making any money. You're just paying the bank. Americans are stuck in right now. That's how the Money Max account we're going to look at in a few weeks is going to help, because we'll get those paid off by reducing about 70% of their interest. So then the cash. Okay, well, like I said, for Bubba, he didn't just wake up and have the money. He had to save it. All right, so now he has the money to make the purchase, but now he doesn't have the money. So about every 5 years, again, he saves and he spends. He saves and he spends. He's not making any profits, but he's not paying the bank interest. So I would say his way is at least better than financing if you can save enough to buy the car. So there's no difference in the two in terms of how it affects you. Then there's a 401k. So let's just say that you had 100 grand and you pulled 90,000 out of your 401k. How much do you have left? 10 grand. There you go. I think I was unmuted. Thanks. 10 grand. All right. That means, so 401ks use a direct recognition loan. What that means is when you pull a loan out, your money's gone. So if you pulled 90 out of the 401k, you're only earning interest on the 10 grand that's left. So even if the interest is 10%, you're only earning, what is that, $1,000 a year? Who's retiring happy with $1,000 a year? So, you know, if I say it's 3, you're earning $300. So you can argue with me all day long. It doesn't matter if it's 300 or 1,000, it sucks. So that money's physically out of the account. The way infinite banking is better is you take the 100, you dump it into the account, the policy. You can loan yourself that $90,000, go buy the vehicle the next day. But when you check your driveway, you got the vehicle. When you check your bank account, you're still earning 10% interest, as we looked at earlier, and you're earning 10% interest on the full 100,000 as if it never left, because it didn't. Does anybody know how this money is in 2 different places at once? It bought you a car and you're earning interest at the same time. Anybody know how that works? Anybody sell IULs? It's the exact same. What really happened is the insurance company, and see, when I put in 100 grand at 45 years old, I bought myself, let's say about right at $500,000. Let's just pretend for my math skills this morning that increases, it's probably around, based off what I put into it, obviously, but it probably earns about 80-ish a year. I'm just going to say 100, right? So it earns $100,000 a year in death benefit, and the cash value is growing rapidly too. So I turn 75 years old and I pass away. It's worth $3.5 million. So what the insurance company knows for a fact is that I'm going to die one day. They know my death benefit is growing and growing and growing. They know my death benefit is always going to be more than my cash value. So if I put in 100 and I borrowed 90, and let's just say they add on a little bit of interest, let's call that 10 grand. I owe them $100,000 for this car. I've never made a payment, right? And that's where I think I made all 3 of you, all my wife, on a training or something the other day, right? Yeah, you're my sister wives. And but the question I asked you was, if I died at 75 years old and I was supposed to leave you all 3.5 million, but you only got 3.4 million, would you be mad at me? And they all laughed. And you can see they all shook their head. No, I'd be all right with 3.4. But that's because the insurance company was using my death benefit as collateral. See, they loaned me their money out of their general fund. They didn't let me take my money out of my account. They just loaned me my money. That's how you borrow against cash value. You're not actually taking the cash out of your account. That's called a non-direct recognition loan. So all the companies that we use that would offer that type of loan, they are all non-direct recognition loans. Questions on that? We good? Keep going? All right, try to hurry. I got to do this other meeting here in about 15 minutes. So, you know, basically, as you pay off your loan with infinite banking, you eventually dig out of the hole and make a little profit. And here's real numbers. So this 30-year-old young lady wanted to buy this Jeep. It's $35,000, 6% interest rate. This is a little while back here. It's probably 10% now. 60 months. There's her actual payment. There's her total payment. All I did was pull up a calculator for, you know, auto finance, and it showed me this. So basically, if you subtract that from that, she paid $5,600 in finance charges. That's not bad. I mean, over a 5-year loan, that's 5, right? Yeah, 5-year loan. I mean, what they make like $1,000 a year. It's not a big deal. It's really not. But you didn't make any money. Okay, so it doesn't affect you in any way. You just paid them to borrow theirs. So if you pull up on, just go to Google and pull up uninterrupted compound interest calculator. Punch in the same numbers. There's the Jeep, 5 years. They charge 5%. That's I believe that's their cap, if I'm not mistaken. They have a variable interest rate, right? Variable on a house would be bad. It could be 2 today and 27 tomorrow. But on this, they have a cap. So it usually ranges around 4, 4.5. That's what it's been for, I believe, the last 20 years. But anyway, I used 5 years, 5%. So now your future value is $44,669.85. Subtract those two, you just made a profit of $4,000 for loaning yourself money from your bank and borrowing it back. Rockefeller did this with millions and millions of dollars. We're talking about buying a Jeep here. Can you imagine how much money he was making off this? That's why he called it the waterfall. It just rained down the money. This young lady, 30 years old, she had a Roth, and she had lump sum, 10 grand. She had about 10 grand in the account. She was putting in the max at the time. I believe it's up to 7,500 now, depending on age, but $6,000 a year. So she's max funding a Roth. And listen, I like Roths. There's nothing wrong with the Roth. But it's my fourth favorite thing. But so here's her putting in the money, right? She takes the 10 grand that she had in the Roth, she puts it in. She's also changing her payment from the Roth to this. So 500 was in the Roth a month. Now it's going into this a month, $6,000 a year. In 5 years, she's got 37,540. Now she has enough money to pull out and go buy that car, right? So let's just say, since I can't scroll down, this is a screenshot. Let's say that whatever this is, 5-6 years later, she passes away. Somebody's supposed to get this $473,000, but they're going to get 473 minus 37,540 because of the loan, right? That's how that part works. You can also turn on income like an IUL. You can just say, you know what, I want a distribution. I want to stop paying you. I want y'all to pay me. You just call up the company and you say, hey, I'm looking at taking distributions. Can you tell me what I would get? They would say, all right, well, you're 65. So far, you've put in 220,000. If you took tax-free income from 65 to 90, you would get 22,530, which means she made a total profit of a profit, right? The total she gets paid is 563. Subtract what she's paid in, profit. She still made $343,000. And here's what that looks like. You can see it. Yeah, and that 2.5 times ROI. And there she just gets a check every year, or monthly, however she wants it. So here's a question that I like to ask clients, and I only give them 3 seconds to answer. So I say, all right, Leanne, you have 3 seconds to answer. Would you rather have $1 million right now in a briefcase, or a penny that doubles every day for 30 days? Which one?
Yeah, the penny that doubles every day.
The penny.
Very good. Well, believe it or not, a lot of people are sharp. They're sharper than we think, right? So when you ask that question, a lot of them do say, I'll take the million. But a lot of them go, you know what? That sounds like a trick question. I don't know why. I don't understand, but I know the penny's right. And they'll just kind of guess the right one. And I show them, here's what this looks like. This is how we show people uninterrupted compounding interest, which works on both of these accounts, IUL and Infinite Bank. There's $1 million in a briefcase. It's really not that impressive. Like in a movie, they make it look like duffel bags, but that's it right there. And here's the penny that doubles. On the 10th day, you're at $5. On the 20th day, you're at $5,000. Day 30, you have 5.3. So had you chosen the easy route, the briefcase, you just lost 4.3 million because you didn't listen to Einstein, who said compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. I've got a bunch of other things that are more or less for you. That's why this one's not necessarily a training that I show, clients, but I don't care if they see it, but these are all articles that I have on my website also. But this is from Time Magazine, why it's time to retire the 401k. Read through this, mainly the highlighted portions. This was the cover of Time Magazine when the market crash hit. It said, the ugly truth is the 401k is a lousy product, a financial flop, and a rotten repository of our retirement reserves. That is strongly worded. I can't say that to people. I can read it. I can't say that to people because it sounds like I'm calling Sandy an idiot for having a 401k. No, I've had like 10 401ks. Like every job I've had since I was probably 18 has offered me a 401k, and I signed up, right? Yeah. I made a little bit of money, but
I'll take that from you. I'll call myself an idiot.
There you go. All right, good. Sandy, you're an idiot. I can't believe you.
Yeah.
Well, see, we don't know though. And to be fair, when Ted Bennett, fathered the 401k into existence, there was only 2 options. You could go fixed or you could go variable market, right? Put money in the market where it was risky. You could lose it all. And people didn't know how this thing works. So they were like, I don't know, let's just split it 50-50, right? So they put half their money in safe and half their money over here in not safe. Today, you have the illusion that you have control over your 401k because when you go to work, they say, hey, we offer a 401k. That's about all they really know of how it works. They really can't explain what it is, how it works. All they know is how to sign you up for it. But usually they have like 50 options, right? He wrote the book Rich Dad Poor Dad. So he's a very wealthy man. Listen to what he says about the 401k.
Out there, they go, oh, now when I talk to most idiots out there, they go, oh, I have a 401k. Well, you've been told the bill of goods, sweetheart. And sponsors his 401k. I said, no, the Federal Reserve and Wall Street sponsors it.
That's for a long time. But in 2008, when I saw so many people losing half of all they developed their lifetime, their retirement, I learned so much about the use that happens to the average person. It's mind-boggling.
Well, specifically, you are a board member at America's Best 401k. And you specifically looked into the fees.
It's the most amazing thing. It's a $4.4 trillion industry that for 30 years, they didn't have to tell you what they were charging you. Only 3 years ago, the Department of Labor changed the rules and said you got to tell people what you charge them. One, fees matter and you're paying them. A 1% in fee, because of the compounding over time, costs you 10 years of retirement income. You have 76% more money if you have less fees, or on the other view, you have 19 years less income. So people don't understand that fees matter.
19 years less income because of a fee. See, we are giving people compound interest, uninterrupted compound interest that we just talked about in our policies. They're charging compound interest on your fee to manage your account. So I love when I post a video on TikTok and I'm talking about IUL, and you know, somebody inherently always goes, you better ask him about all the fees. And I'm like, you sell 401ks, don't you? Or you work for the government, you're trying to protect their tax dollars. What, like, there's got to be something. Because if you actually knew how the fees were calculated on your 401k, you would realize that you're pointing this finger at me and you're pointing these back at yourself. So the fees on the 401k, have y'all seen that? You know what I'm talking about?
No, but I have a client you need to talk to, because I talked to him yesterday and he's like, this isn't one of those things where you're going to make me roll over my 401k into something, is it?
Talks about how the employer match isn't real, talks about how the tax deferral is a scam, but the biggest one is the fees devour up to half your hard-earned money. Just like you just heard Robert Kiyosaki and Tony Robbins say, this is the guy who fathered, I call him the inventor. He didn't invent the 401k. The 401k is a tax code, and it was already in the IRS handbook, but it was like a one-pager, and he basically found out how to use it and put it into action. He's the first one to use it. So basically, he made it what it is today. So he's known as the father of the 401k. But he's the guy that went on record and said that this has gotten to be out of control. It's a government scam. And you should put your money into life insurance. And that's where he said, I put most of my money into a 501k, meaning upgrade from a 401k. So if you had 100 grand in a 401k earning 7% over 35 years, you would have $1 million in your account. If I ask you, how much did you pay in fees? You have a 1% fee. You would be doing math. $1 million, 1% of $1 million, that's 10,000. I paid them $10,000, Shannon. That's all they charged me. No, it's not. That has compounding interest on the fee. So what Tony was saying when he said, you know, they would have taken 20 to 30%, literally 28.8% if it was 100 grand earning this over that amount of time, right? That's the math. But 28.8%. They just took $300,000 out of your $1 million to manage your account. People do not know this. People that sell them don't know this. She is a securities expert and teaches economics. So she went on record and said, we've run the 401k experiment for 40 years and pronounced it a failure. Now she's doing this podcast series. So she drives around and interviews people. And if you go on my TikTok, there's a video somewhere where she interviews this kind of elderly couple. And again, I'm probably getting the details wrong. It's, you know, ADHD. But I think they were 72 and 74. And basically, it's like a news report. She says, this is Bob and Mary, and they're getting ready to go to their jobs. It's 5:15 in the morning. They're packing sandwiches into Ziploc bags. It's like, you know, Bob, what did I say, Bob and Tom? I don't even know the names I just used. Tom and Mary. Tom is working at the docks unloading crates of fish for like $15 an hour. And Mary is working as a legal secretary making 13 something an hour. And then it cuts to a scene where they're on the couch and she asks the lady, she says, so this retirement plan you're currently living, how did you get here? And she said, well, when we retired with our 401k, we had about $100,000 and we realized after about a year, this is going to run out. So we had to go back and get jobs again. She says, so what do you call this current retirement plan? And she goes, I call it working every day. And I hate that. That's sad. I mean, every time I walk in the Walmarts, you know, where I live, and and I see like this little old man that's 80 years old in a wheelchair with an oxygen mask, and everybody that walks in, he goes, I'm like, oh my God, like who put you here? This wasn't your plan.
My stepdad is 80. He retired in 2019 and is now working 2 jobs to put food on the table.
Gosh, see, that's rough. I don't want my family to be there. Nobody wants their family to be there.
No.
And there's a way to fix that. There's a way not to be there.
Yep.
So that's what we want to help people with. That's what this is all about. You combine this with the Money Max, and I'm telling you, it is game over for the bank taking our money and for us being broke and having to rely on so much help from the government and all kinds of things.